I'm going to hand the moderation over to Andy Howitt, our Senior Vice President and the bank's policy leader for Household and Regional. Andy's also a contributor to the blog series and has spent a career looking at many topics, including those that impact households and communities. Thank you, Andy.
Thanks very much, Nora. It's great to be here, and welcome to everyone to the Federal Reserve Bank of New York. I'm very glad to see such a wonderful turnout. And I'm very happy to be here with my colleagues from the research group. We are here to talk about the research that we do on a variety of different subjects, as you'll soon see. But none of the views that we'll express are necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. They're really ideas that emerge from the research that we're doing. So let me introduce the panel before we get started. And I'll start down here at this end. At the far end from me is Fatih Karahan, who is a senior economist in the microeconomic studies function. Next to him is Jason Abel, an assistant vice president and the head of the regional analysis function in the research group. Beside me here is Maxim Pinkovsky, a senior economist in microeconomic studies. Raji Chakrabarty, another senior economist in microeconomic studies, and Wilbert van der Klauw, who's a senior vice president in microeconomic studies. So that's the panel. There's a lot of expertise up here on a wide variety of subjects. I'm going to start off by asking Raji, who was the sort of organizer of the blog series on which the panel's based, to tell us a little bit about why you decided to put together this blog series and how it came together.
Sure, thanks, Andy. So there is a very big body of work here at the bank on inequality, on various dimensions of inequality. And we decided in this blog to just put together a very small subset of key findings that might be available to outside researchers, practitioners, and policymakers. The idea is to start a dialogue and debate between us and you guys, and to kind of, first of all, inform you guys about the findings that we have, the research we have, and understand from you and get your feedback, your thoughts, and so that may actually inform our research moving forward. And today, for example, is an event like that where we would like to have your feedback and your thoughts that might actually inform us for the future.
Thanks, Raji. Okay, so the people before you each are representing one blog apiece. So those of you who have had a chance to read the blogs will sort of know what the subject matter is. We've decided to break it down into two pieces because the blogs are sort of roughly divisible into two general areas. So we'll start out with a series of blogs that are kind of on labor-like topics, income inequality, earnings inequality, but also health inequality. So we'll start with those. And then we'll follow up with the second segment that's more about student debt, which is a kind of a specialty here at the New York Fed, something we've invested a lot of time and effort in studying. And so we have a couple of posts by Raji and Wilbert that will focus on those topics. I want to also mention in the series, there's a final post by Haoyang Liu and Christopher Palmer of MIT. That post is about home price expectations and variability in how people form and act upon their house price expectations. So that's a little tangential to some of the other subject matter here, as you can probably tell. And so we decided to put that aside for today, and we'll hear from Haoyang in in some future work. He's working on evictions and lots of other important subjects that have to do with housing. And so you'll surely hear from Haoyang in the future. Okay. So let me now start by asking, let's start with Jason Abel. Why don't you take a few minutes and explain what your blog's about, and then we can talk about it a little bit in the context of the other blogs. I'd also like to mention that your post was co-authored with Richard Dietz, who's also in the Buffalo.
Right, okay, thanks, Andy. So the title of our post was "Some Places Are Much More Unequal Than Others." So it's probably no surprise to everyone in this room, economic inequality has been on the rise for a number of decades in the United States. It's become one of the most important economic and social issues that we face. There's many different forms of economic inequality, which I think is reflected across the entire panel here. There's wealth inequality, income inequality, health inequality, education inequality. It's important to make sure we're defining terms, and so our blog post was focused on regional wage inequality. which is the difference in the wages that workers earn in labor markets across the United States. So a couple really important points here. So first, when you're thinking about wage inequality, you've probably all heard about the 1%, you've probably heard about even the 0.1%. It turns out when you're thinking about wage inequality, it's a much broader phenomenon. In fact, if anything, wage inequality is much more about the other 99% than it is about the 1%. That's an important point. Secondly, by now we've actually started to see quite a bit of economic research that's helped us understand what's happened at the national level in terms of economic inequality, but we still don't know a lot about how inequalities played out at the regional level, and that's what our blog post really hits on. So in terms of highlighting some of the key findings, so while it's true that inequality has risen everywhere in the United States, almost everywhere, it turns out that some places really are much more unequal than others when it comes to wage inequality. And importantly, what we find in our work is that the most unequal places now tend to be large urban areas where skilled workers at the top of the wage distribution have seen outsized earnings growth. Places like New York City actually fit into this puzzle. Now, this was not always the case. If you were to look back in the 1980s, for example, there was no connection between the size of a place and how unequal it is. So that's something that's developed over several decades. It also turns out that the least unequal places tend to actually be places that are seeing lackluster wage growth more or less across the board. So wage growth has been in a much tighter window, and it's been particularly true among middle and low wage earners. And these are also economies that are weakening or have seen fairly sluggish economic growth. And so places in upstate New York tend to fit this profile, and a lot of the Rust Belt region overall. In trying to understand these patterns, we point to three powerful economic forces that are at work. Probably the most important is that technological change and globalization have had geographic impacts. So these very powerful forces have affected different places in different ways. Some places have actually benefited from technological change and globalization. These large places that tend to have finance sectors or a tech sector or are providing complex services that require high human capital. Those are places that have benefited, places like New York and San Francisco. But other places around the country, mostly manufacturing hubs, places like Buffalo, New York, and in the Rust Belt, have actually been on net hurt by these forces, where manufacturing jobs and a lot of jobs in the middle of the wage distribution, these forces have put downward pressure on wages or even displaced workers altogether. So that's the biggest driver, but in the blog post and in subsequent research, we also explore some other explanations, things like the emergence of urban agglomeration economies, which are the benefits, the productivity benefits that come to workers from being in large urban areas. Those are actually more important for high-skilled workers, and so it adds an extra oomph to that pulling away at the top of the distribution. And then the last thing we highlight in our post is looking at migration patterns within the U.S., and as it turns out, high-skilled workers have actually increasingly located in these large urban areas, and so that has changed the composition of these areas and it's reinforced these agglomeration patterns. And so all of these forces together have worked to reinforce one another and create these patterns of regional wage inequality. So that's the gist of the blog.
Thanks. That was great. That was a really clear explanation. So Fatih, you worked on career ladders, so maybe you could tell us a little bit about the role the career ladders play in inequality in the labor market.
Thanks, Andy. So this is actually joint work with Brandon Moore, who's over there, is one of our brilliant research assistants, and with Sardar Özkan, who's a professor at the University of Toronto and external collaborator. The starting point for our work was the observation that a large share of income inequality, differences in income, in labor income, actually arise during the working life of a cohort. So that is to say that if you start following a group of people, let's say from when they are 25 years old, they entered the labor market recently, all the way through their career, what you see is that there are differences in their income, in their wages and earnings, when they are 25, but those differences are much, much smaller compared to the differences that arise when that group reaches, say, age of 55. And so just to put things into perspective, let me give you some numbers. If you take the top 2% of the US population, these are the ones with the highest income, they experience about 27-fold increase in their annual earnings. So they make 28 times more, 28 times of the income that when they're 55 compared to what they were making in 55 and 25 in real terms. So it's a huge growth. If you do the same calculation for the bottom of the distribution, that group actually does not experience any increase. Actually, their income declines in real terms. So they make about 7% less when they're 55 than they were making when they were 25. And so we wanted to really understand what's going on in there, what contributes to those differences. And specifically, we looked at the role that the job ladders play. So the job ladder is the idea that large growth in wages, large increases in wages usually come when people switch employers. You know, you start out with a career, you have a good job, but then you are poached by another employer that wants to hire you, and that's when things start looking good, because then they have to make you an offer you cannot refuse. And so that's when things look good. But this is a story that works in the data for the average, and we were interested if there are differences. Maybe this works for some individuals, but not for others. And that turned out to be the case. So we have three main findings. One is that there's a very high unemployment risk at the bottom of the income distribution. So people with low wages, they're about 3 to 4 times more likely to lose their job within a few months compared to people that are at the top of the distribution. And that's very concerning, because you really need stable employment to have a good career. You need some work history so that an employer is going to come and approach you and try to hire you. Then we also looked at differences in job finding rates. Maybe the idea is that, okay, these people are more likely to lose their jobs, but they can find employment quickly. That's also not the case. People at the bottom are having a much harder time when they lose their job coming back to work. And so this also implies that they might be losing valuable skills during the unemployment spell. And lastly, we looked directly at job switching patterns and how likely are the different people being to be poached. What we saw there is actually high-income people get more contacts. They're asked if they're interested in alternative jobs and so on, and they receive more offers. They do switch a little less, which was a little bit in contrast to what we were expecting before we did the analysis. But our interpretation, which is also confirmed by other studies, is that these people do get more offers, but they are retained by their employers, and that is because they are getting wage increases. So they get maybe promoted, but they're getting raises, and so they stay. And so overall, our conclusion is basically that job ladder is really important on average, but it works way better for people at above the median, kind of more towards the top of the distribution, and it just doesn't work at all for the bottom workers. And that's an important source of the differences at the bottom.
That's great. Thanks, Fatih. So Maxim, you wrote on something that's a little different. It's more of a sort of welfare outcome, I would say, than a story about income. So tell us a little bit about the analysis you did in your post.
So my post was about inequality in life expectancy across the United States. And life expectancy, as Andy said, is a welfare outcome and one of considerable concern. It's one of the 3 components of the Human Development Index. Just this morning, the Times ran with a story on life expectancy in the US increasing after 3 years of successive decreases, so it's important. And over the last 20 years, I think my blog deals with the last 15 years, life expectancy inequality, like many other inequalities in the United States, has increased. And also, life expectancy has become much more correlated with income. If we think about the average life expectancy and the average income across US counties, then a 10% increase in the average income was associated with a life expectancy longer by about 3 months in 1995, but a life expectancy longer by about 5.5 months by 2010. and as late as 1995, variation in income across US counties explained only 15% of the variation in life expectancy, whereas by the early 2010s, it explained about a third of the variation. And these facts are very stark, and they have been documented in other settings, and they lead to they lead to an intuition that it's harder for poor people, for example, to access quality health care, and perhaps easier for rich people. That income has some kind of a causal effect on life expectancy. And while this intuition may be true to some extent, a very interesting pattern that I've noticed in the data is actually that much of this correlation seems to be explained by risky health behaviors not having been very polarized across the income distribution in the 1980s and even in the 1990s, but now becoming increasingly more concentrated in lower income areas. So in particular, if one accounts for smoking prevalence in the United States has declined on average between 1995 and 2010, but it has declined far more in the areas that have grown more than in the areas that have grown less and that were poor to begin with. So whereas in 1995 there was a fairly weak association between smoking and income, although the association definitely was there. By the early 2010s, this association has become quite strong. And what I show in the blog is that accounting for this change, for this growing association between income and the lack of risky health behaviors such as smoking, to some extent, smoking you can think of as a catch-all for many other behaviors like alcohol, drugs. Smoking is correlated with the deaths of despair that you may have heard of, the opioid abuse. When we account for the change in correlation between these behaviors and income, the association between life expectancy and income is the same as it was, say, in 1995. All of the intensification in the relationship between life expectancy and income can be statistically explained by the intensification of the association between income and these risky health behaviors. So that's the punchline of the blog.
So that's a very stark and startling and really provocative conclusion. So thanks for that, Maxim. So let's talk about a few of these subjects and how they link to each other. So maybe I'll start with you, Fatih. It seems like the point of the blog, or one of the main points of the blog, is that an important part of inequality in wages over a career has to do with the instability of jobs at the bottom end of the income distribution. So people who start out with low-wage jobs or who end up somehow in a low-wage job find themselves more likely to have unemployment spells, and for those spells to last longer. Is that a fair characterization? And if so, tell me what you think that suggests for policy, or what kind of remedies we might think about there.
Yeah, so that's a great question, a very, very accurate description. So it does turn out to be the case that if you wanted to explain the differences, let's say, between the bottom income individuals and say the median, about 80% or 70-80% of that can be explained by the lack of job stability and by the high job loss risk and so on. And so that's very large. Now, we find this to be very important, and we want to think more about it To go from there to making policy prescriptions, obviously we need to understand what is the reason that some people have much higher unemployment risk. They cannot find stable employment. Because for a lot of people, actually, what happens is they start, when they're young, they have a few unemployment spells because they try stuff out, it doesn't work, but eventually they settle down. That's not the case really at the bottom is what we found, that over the life cycle, even those people, when they are 45, 50 years old, they still are more likely to explain unemployment as much as they were when they were 25. So there's something that going on there that we really need to understand. One possibility is the types of jobs that they work. They somehow get stuck in these occupations that typically aren't really associated with stable employment. That's one possibility. The other possibility is that they are not coming from certain backgrounds, let's say they don't maybe have the appropriate skills to maintain jobs. And so the two explanations would call for very different policy prescriptions. In one case, we would need to revisit how our education system is working, not just college, maybe even earlier. In the other one, we would need to think about policies that would promote job stability, and those are just another set of policies having to do with how to subsidize jobs that have more of a career than are short term. But my work really doesn't speak, cannot really make succinct policy prescriptions at this point.
Okay, thanks. So, Jason, you made a little bit of reference to some of the metropolitan areas in our district. So I'd like to, since we're in our district, sure. I'd like to pursue that a little bit more. New York City is a very large and in many ways very successful metro area. Where does it fall in terms of inequality, and maybe compare it with some of the interesting cases upstate, if you would?
Sure. So it turns out that in the second district we've got almost a little laboratory going on, where we've got New York City, which is just the poster child for agglomeration and all the benefits that come with it, as well as some of the costs. And then we've got other parts of the region, mostly in upstate New York, that are more squarely in the profile of the least unequal places. So New York City is, I think, a top 10 place. I think it ranked number 7 in our study overall. A lot of the things I talked about in terms of what's driving big differences in wage inequality, we can see happening here in New York City. So if you think about the pros and cons of globalization and technological change, this is a place that attracts skilled workers. It's got a strong demand for a skilled workforce. It has, it's a financial capital in the world. All these things are helping high wage, high skilled workers, increase their wages and earn more. It's obviously got the agglomeration benefits that come from being in a big city with all kinds of opportunities for matching into the jobs that make you most productive, to learning from other people, to exchanging ideas and innovation. So these are all things that are driving New York City's economy. One thing we found in our study that was interesting is that actually New York City wasn't always among the most unequal. If you were to go back in like 1980, New York City was more or less in the middle of the pack. And so a lot of these forces have emerged over these several decades to create it be more unequal. And one of the things that's happened is that high-skilled workers have increasingly flocked to places like New York City, and that's completely changed the composition of workers. So when you're looking at a measure of inequality from, say, the 1980s to now, what you're seeing is a different set of people and a very, very specialized and highly skilled workforce that we have here. When it comes to places like upstate New York, a lot of these are manufacturing hubs. And so the other side of the coin when it comes to technological change and globalization, a lot of these good high-paying jobs have been more or less replaced by either less expensive labor overseas or by robots, which has put downward pressure on that part of the wage distribution, as well as even displaced many workers in those areas. And these areas have not tended to attract those high-skilled workers in quite the same way. So the wage distributions are much flatter in places like upstate New York.
So I just want to give myself a quick follow-up as a prerogative of the chair. One really interesting place is Albany. Can you say a couple words about Albany? Yeah,
so Albany looks a little different than other places in upstate New York. It's still among the most unequal, the least unequal places. So inequality has not risen much there. But when you look at its wage profile, It's actually had above average wage growth for most of the wage distribution, with the exception of the very, very top. That's what's kept its overall level of inequality in check, I guess I would say. And Albany has been a fairly strong performer within upstate New York, and it's got a couple of unique features to it. So one, of course, is that it's a state capital. So a state capital tends to attract a pretty skilled workforce, tends to be more in the middle of the wage distribution. These tend to be fairly steady jobs that Fatih's noted the importance of, and they pay pretty well. But it's also, even though long-term Albany, like other parts of upstate New York, have seen declines in its industrial base, through a lot of innovation and innovative policy, it's built a very successful nanotechnology cluster, which has provided strong, highly skilled manufacturing jobs in that region. It's actually been growing. And again, that's supported the middle part of the wage distribution, even some parts of the lower part of the distribution, but again, not much at the upper end of the distribution. So that's what makes Albany a little different from the other areas in upstate New York and the Rust Belt overall.
Thanks, that's very helpful. So Maxim, your analysis focuses in on how health has changed over time and over these different kinds of places. And one of the conclusions is that health or life expectancy has improved the most in some of the exact kinds of places that Jason was describing as having the biggest inequality differences. So how do these facts fit together? Or how do you see the relationship between your work and what Jason and maybe also Fatih's results show?
So that's an excellent question. I think if one were to think about the US county data I was talking about geographically, then the thing that would stand out the most is that in the 1980s and to a lesser extent in the 1990s, the large central metro areas, many of which now have rising inequality, but also rising average incomes. Back in the 80s and 90s, their life expectancy in these large central metro areas was much, much lower than what one would expect given their incomes at the time. And to a substantial extent, the story of life expectancy becoming more correlated with income has been a story of life expectancy in these cities like New York, San Francisco, Chicago, Boston, and so on, increasing their life expectancy from far below what you would have predicted to about what you would have predicted given their income. And this happened possibly despite, possibly in part because of rising inequality in these areas. And I think this is a very interesting empirical observation. Raj Chetty has a fantastic paper on life expectancy inequality in the United States, mostly focusing on the 2000s rather than the 90s. But in that paper, he documents that if we think about the life expectancy of people in the bottom quartile, in the bottom 25% of the national distribution, their life expectancy in more unequal places is actually higher than it is in more equal places, which seems almost, which seems very counterintuitive at first blush. But perhaps when someone lives in a place with a lot of rich people, there might be some negative externalities. One might experience stress that one is not as rich. But then there might also be positive externalities because health depends a lot on public goods like quality hospitals or maybe just a culture that promotes healthy behaviors. And having a lot of rich people around can help bring these positive externalities about. So I think Jason's story and the story that I'm telling in my blog actually form two strands of a common motif that is very relevant for discussions of inequality.
Thanks, that's helpful. So, I mean, one of the themes that I think emerges from these three posts is that, you know, for both Maxim and Jason's posts, they're specifically about cities. Fatih talks about career ladders, but one implication might be that there are some variations in career ladders over places. Has anybody thought about that, or is there much research on that kind of subject? How career ladders might vary in different places, Fatih?
Yeah, so absolutely. So there is this idea that in large cities, the job ladders look better. The career ladders look better because there are more firms, there are a lot more job openings at any point in time. And so if you work in a large city, chances are much higher that you're going to get poached, you're going to be approached by another firm, and so increase the larger wage growth. In fact, one story for why wages are higher in larger cities is exactly this. There are a lot more opportunities, so the career ladders are actually steeper. Whereas if you work in a little town where there's maybe only one or two employers, it's really hard. You either work for one or the other, especially if you're doing a very specific task. So that's definitely a part of it. I have not seen a quantification of this thing, but I've heard a lot of discussion, so I wouldn't be surprised if people starting do more work on this.
So I'll just add to that we talked a little bit about urban agglomeration economies being one factor that's been driving these patterns in regional wage inequality. One of the reasons that larger areas are more productive is because large areas facilitate better matching, which is very related to the job ladder. And so research I've done has shown that that's the case. Other research has shown that actually workers, while they do experiment in their early years, actually find that match a little quicker in large cities, which suggests that the wide array of openings and ability to experiment, to find that match quicker is very consistent with the idea that the ladders would be better as well. So better matching, better job ladders is part of the agglomeration effect that drives these differences.
And I'd like to add that it seems like these agglomeration effects may have intensified over the last 2 or 3 decades. Back in the early 80s, even as late as the early 90s, American cities were not doing particularly well. And now, both in terms of income per capita, in terms of being dynamic places to work, in terms of the health of their inhabitants, they seem at or close to the forefront. So it's something that not only is important, but it's something that has become important relatively recently.
Thanks. Okay, so now I'm going to ask the authors of the student debt blogs to describe their work. Wilbur, you worked with Joel Scally and Dong Hoon Lee and me on a post. Why don't you tell us what that was about and what the main conclusions were?
Sure, thanks. So as Andy mentioned earlier, and I think many of you might be aware of, is that we've done a lot of work on student debt over the last decade. And that's partly because we have really good data on student debt that we acquired from a credit bureau. So what we have documented over the last 15, 20 years, there's been a huge increase in student debt. And we're now at $1.5 trillion of debt. That's 5 times more than what it was in 2003. At the same time, what we're seeing is a big increase in delinquencies. So a lot of people have trouble repaying. That shows up in these high delinquency rates that actually have stayed very high. So after the recession, what we actually saw were declines in delinquency rates on mortgages, on auto loans, on credit cards. For student debt, you don't really see that big decline. It's been staying high. It's about 15% of debt transitioning into delinquent status. At the same time, when you look at repayments, you see similar problems. And people are actually not repaying very fast. So recently we looked at repayment rates and we saw that about only 36% of people who are current on their student loans have lower balances now than what they had a year ago. Okay, so the others, the balances are either constant or they're going up. Okay, so that's again not a good sign. So these problems with student debt have led to a lot of discussions in the media and policymakers and politicians, and they've come up with new ideas of how to deal with it, one of which is forgiveness, debt forgiveness. So the idea in our blog was to actually look at what effect that would have. Or a broader question that's related to that is, okay, who actually holds the debt, right? Who is struggling with this big amount of student debt? So to look at that, we wanted to see how it varies across people of different income groups. Now, in our data, we don't observe income, but what we do is we look at where they live, and then we look at the average income in their zip code. Okay, and then we divide all the people that we have in our data, which is a representative sample, very large representative sample. We divide it into 4 groups, 4 quartiles, from low income to high income. Okay, and then we look at the patterns in the data and see how these different income groups, how they compare in terms of how much debt they have and how much they're repaying or not repaying. So what we find is, first, when you look at these income quartiles and you look at how many borrowers there are in each of these 4 groups, surprisingly, the numbers are actually very similar. Now, that's surprising to us because if you think about the lower income groups, well, the proportion of those individuals that go to college is much lower than at the higher income end. So fewer go to college, but they have about the same number of borrowers in these areas as in high-income areas. Okay, so that was a surprising finding. So it's really kind of flat, the proportion of people in a location that are holding student debt. Then we looked at delinquency rates. Before that, we looked at the average amount of debt that they had. Okay, so there what you see is actually slightly increasing by income. So the highest income group has the highest amount of debt, also meaning the highest average amount of debt. But actually that comes mainly from people who have very large amounts of debt, over $100,000. Okay, so it's a small proportion, but they really add up to a large amount of debt. Okay, when you kind of take that group out, then actually student debt is not really that different. So the average amount of debt across these income quartiles is not very different. But of course, their incomes are very different, right? They live in lower income areas or very high income areas. So they owe the same amount of money, but they have very different income levels. So that means if you look at debt to income, like how much is this burden as a percentage of your income, you see that it's much, much higher at the lower income end than at the higher income end. Okay, so not surprisingly, you see that also in the delinquency data. So delinquency rates are much higher in low-income areas than in high-income areas. So that was perhaps not a very surprising result, but what we were surprised about is how much debt there actually was in these lower-income areas. And so if you're going to have debt forgiveness programs, we have now a better sense of who is going to benefit from that kind of debt forgiveness.
Thanks. And Raji, your post, also with William Nober, who's here, and Wilbert, who's sitting next to you, also dealt with student debt. So why don't you tell us a little bit about it, how you did your work?
Sure. So as Andy says, this post is joint with Will Nober, he's sitting there, and Wilbert Vanderklau by me. This post is on the effect of tuition subsidies on college enrollment and student debt and default. So if you look back at the past 2 decades or so, there has been a steady increase in tuition prices, so much so that over the last 2 decades, there has been a doubling of tuition. And you see that in the public sector, it's in the private sector, everywhere. You see that for 2-year colleges, 4-year colleges, etc. So partly as a response to this, many states have instituted what you call free tuition programs or free colleges. They are mostly in the community college or 2-year college sector. And most recently, New York is currently rolling out its Excelsior scholarship, and that is applicable to 4-year students as well who are low income. So as you can see, there are a bunch of these free college programs floating around, but it is not very easy to study them or look at the effects of these free college programs because there isn't much data on them and they are very concentrated. They do not span big areas. So because of a lack of adequate data, it's very difficult to understand the effect of free college programs, although it is definitely an issue of policy and research interest. So instead of that, what we do is we look at tuition subsidies and a specific form of tuition subsidies. These are merit scholarship programs. These merit scholarship programs have been in existence for a very long time. The first program was instituted in 1991 in the state of Arkansas. Another advantage is that these are statewide programs, so there is a lot of variation. So starting from 1991 till date, there has been 27 states that actually instituted these merit scholarship programs. So that gives us a huge amount of variation spanning both time as well as across states. So that is what we exploit to look at the effect of tuition subsidies on both college enrollment, educational attainment on the one hand, as well as student debt and default. And the way we do this is we basically see at the point where an individual turns 18, which is typically when one starts college, and we try to see whether that individual is in a state that already implemented a merit aid program. If this individual is in a state that already implemented a merit aid program, we call that individual to be eligible for merit aid. Other individuals are not eligible for merit aid. So that's the basic method that we use, and using that, we basically compare between merit-eligible cohorts, or their outcomes rather, with outcomes of cohorts that are not eligible for merit aid. And apart from just looking at average effects, we also try to see if there are differences by demographics and by income. What we try to say is that if individuals who originate from, let's say, low-income neighborhoods or high Black or high Hispanic neighborhoods, do they have different effects of merit eligibility in terms of education as well as debt and default outcomes relative to the ones that do not actually originate from these areas? So that's basically the post, or those were the kind of the questions that we look at, and the data that we use is that data that Wilbur just mentioned to you. It is basically a match between that consumer credit panel that came from Equifax that has credit records of individuals as a panel, and a match of that data with education records from the National Student Clearinghouse, which gives you education records at the individual level. And using that data set, we basically look at these questions. So what are our findings? So we find that merit eligibility basically has no effect on college going. And this is true for the average individual as well as across, when we look at across either income levels or race levels. When we move to student debt, however, the findings are quite different and quite interesting as well. We find that merit eligibility actually leads to a pretty big decline in student debt around the time when people go to college, so early and mid-20s. And this is even more prominent, as much as double more prominent, or it's basically twice less for individuals who originate from low-income neighborhoods or individuals who originate from high Black or high Hispanic neighborhoods. And then we move on to look at delinquency and default patterns. We find that on average, there is a very small decline in both default and delinquencies for the average merit-eligible individual relative to somebody who is not eligible as we have defined them. And when we look at variations or differences across race and income, we actually find even larger declines in delinquencies and defaults for students who originate or individuals who originate from low income or high Black or high Hispanic neighborhoods. That's basically the blog. We are kind of continuing our research on that, and we actually have future blogs that will look at, whether or not there has been credit substitutions, whether or not, as a result of this decrease in student debt that we find in this initial college-going ages, there has been substitutions into credit card debt, increases in credit card debt, auto debt, or home debt.
Thanks. And just a quick follow-up to make sure that everyone understands. Can you describe the way you classify the different neighborhoods?
Yeah, so I should definitely have said that before. Thanks, Andy. So the way we classify the individuals into neighborhoods is basically we see when they first appear in our data, the zip code that they first appear in our data. And then we find the income and the race composition associated with that zip code. We look at the distribution of the zip code incomes, and people who have originated from zip codes that lie in the lowest quartile of the income distribution are going to be called as people originating from low-income neighborhoods. Similarly, for the races, we basically look at the distribution of races, the zip code race distribution for these individuals, and call people who come from the top quartile of the Black and the Hispanic race distribution, respectively, coming from the high Black or high Hispanic neighborhoods.
So those are shares of the people living in those
That's exactly
neighborhoods.
right, yeah.
Okay, thanks. So, yeah.
Can I jump in? You have about 15 minutes left.
Okay,
Is that right?
yeah.
Okay. So lots of questions from the audience around
Okay.
like definitions of terms and things like that, sources of the data, and I think we just referred them to the link in your invitation that takes you to the blogs. You'll see in the blog series there'll be hyperlinks and footnotes that you'll be able to get to that. So there were many questions around that. I think we can.
Yeah, maybe, and I could just add, I mean, many of those blogs will also link to papers, which will have more detail than you could ever want, I'm sure, on subjects like data sources and methods.
I wanted to follow up on Raji's point. The first presenter really focusing in on kind of cutting the data on, particularly on race, and there were at least 15 questions on that for all of you to sort of thinking about looking at your findings through a racial lens. How might you tell the findings story a little differently? Several questions came in around what I'm now grouping under the Albany experience, this sort of the positive outliers. Are there places with lower student debt, or are there places that have better health than you'd expect, or somehow job ladders that seem to be more productive in some way? And if there were success stories like that, if you could maybe highlight them. And then there were lots of questions that I think are going to land with Claire Kramer-Mills' panel that's coming up next around what are some possible interventions. And I'd like any of you to sort of talk about those too. But there were questions about opportunity zones. Is that something, and other place-based investment tools like the New Markets Tax Credit and others, Community Reinvestment Act motivated debt from banks. Is that a tool that can help combat some of these problems around jobs, health, and other opportunity in communities? But I think we're going to get a little bit more into those also in the second panel. So I just wanted to throw those out before we run out of time. We're going to stop at 4:45, so we've got about 15 minutes left. Okay?
Okay, great, thanks. So maybe I will ask the two student debt presenters to talk a little bit about some of those themes, in addition to sort of a broader theme that I want to get out on the table, which is maybe for the whole panel, first the student debt people and then the labor people. What role is education playing here? I mean, we often say, economists also often will say, well, education is a main way to address inequality. Improving education, inequality and outcomes can certainly be helped by that. But there's some sense in which the student debt work maybe suggests that education is a little bit of a two-edged sword. So I'd like to get you guys to talk about that a little bit, and then throw it open a little bit broader as a potential avenue, in broad terms as a solution.
Okay. Maybe. You hear me? Yeah. So I just want a quick follow-up on the question about race and ethnicity. So we did look at differences in student debt and delinquencies also by the race and ethnicity of the neighborhood. Again, we are doing this at the zip code level because we don't have individual level data. All our data are also anonymized, so we don't know who is who. But looking at these zip code levels, and we look at the composition in terms of race and ethnicity, what we find actually is that student debt, the percentage of borrowers and the average amount of debt are much higher in black neighborhoods. Okay, so that's unlike with income. Actually, student debt was increasing with income. So it is still a little bit lower, the average amount a little bit lower in lower income areas. When you look at high proportion black neighborhoods, actually average student debt was higher. And if you look at defaults, or delinquencies on the student debt, twice as high, okay, in high black neighborhoods, percentage of black neighborhood versus white neighborhoods, majority white neighborhoods.
So I can add to that, and we actually have an ongoing work, and we will have a blog series which will actually relate to exactly what Wolbert said and the role of education in actually explaining those differences between the black and Hispanic and neighborhoods, as well as we also look at low-income neighborhoods, the differences in debt and default, and how much of that can actually be explained by differences in education, which ties into the role of education question. I'm not going to give out the results because you'll see them actually coming out later in spring, but that's something that is work in progress, and there will be a blog in spring that will be exactly based on that.
So maybe I'll turn to what I call the labor guys and ask you to comment maybe jointly on the role of education and race and ethnicity in the results that you've got, or how they interact.
So I was going to talk about the education and maybe even bring in a little bit about place-based policy. So, I think education is one thing we can point to that could help alleviate wage inequality overall, and certainly in different parts of the country. So if you think, one of the things that make economic inequality such a hard topic to wrestle with is that a lot of the same forces that are creating growth in economic progress overall are also the same forces that are leading to inequality. So if you think about things like technological advancement, investments in physical capital, and the opening of markets, these are all things that help us grow and help us prosper, but they're also things that widen the gap. The one thing we can point to that both increases growth and prosperity, but also has the opposite effect on inequality, is investments in our human capital. So one way that we invest in our human capital, an important way, is through education. And it's a little known fact, I think, that while there's a lot of perception out there that we have an overeducated population, actually the growth of a skilled labor force has slowed considerably since the 1980s, exactly the same period that we've seen this rise in inequality. It used to be, over most of the 20th century, that each successive generation was having 2 or more years of additional educational attainment. That's slowed to well under 1 year now. So we actually have an issue where we've got continuing growing demands for skilled labor coupled with slowing supply of skilled labor, and that's really what's putting the pressure on in terms of wage inequality in the labor market. So investing in education and human capital is one solution to that. What becomes tricky when you start to think about it from a regional standpoint, however, is that as you educate people, it's the educated, highly skilled workers that are actually the most mobile, and are the ones that are leaving certain parts of the country and moving to the areas that are thriving. So a couple things that you can think about on the front of education overall, we think there's a big role that community colleges can play because they're much more tied to their local labor force. They can work with local employers, and the people who are trained at community colleges are much more likely to stick in those areas. So we, in addition to K through 12 and traditional four-year education, we really think there's a role to play for community colleges going forward. And then this is also, I think, where potentially some of the place-based policy could come in. Wage subsidies or employment subsidies that are targeted toward these areas that have been struggling could be a way to potentially support that, support those areas and get a little bit more, dynamic economy going on there. So, overall, the message is that the clear policy recommendation to address wage inequality is through educational attainment with a few twists in there.
So when looking at lifetime incomes, we couldn't really break anything down by race or education because our data comes actually from Social Security Administration, tax records there, and tax records don't have any of that information. Having said that, there's a lot of other work that look at the rise in inequality and how much of it can be explained by what we call the skill bias technical change. The idea that a large chunk of the technological progress that we have had over the last 20, 30 years has been biased towards college graduates, meaning that they benefited a lot more people with college degrees. And so there are ways of controlling for that, getting at that, and that does explain about 30 to 50% of the rise in income inequality. That means college is very important. Having a good education is extremely important, but it also means that there's a large chunk of inequality that we still don't understand, and that I find very interesting. On race, I just want to add more just one thing that the last few years, which isn't really covered in our analysis, has been very good on addressing racial inequality. Given the continued improvement in the labor market, it's been good news that the gap in, say, participation rates between, say, blacks and whites has been closing a lot, and unemployment rate gap also has closed down a lot, although it's still there.
So both education and race are definitely very relevant to health inequality. My blog was mostly on aggregate trends, in part because it was comparing life expectancy to county level income, which was harder to break down by race or by education level, but some useful facts to keep in mind concerning health inequality and race. There are very large racial gaps in life expectancy, and African American life expectancy is considerably lower than the life expectancy of whites, although the life expectancy of Hispanics tends to be higher. But these gaps have been recently evolving in very different ways. The life expectancy of blacks and Hispanics has been rising, while the life expectancy of whites has been stagnant or in many places falling. You must have heard of the deaths of despair, and that is a primary driver of these trends. To some extent, unfortunately, the deaths of despair are beginning to spread to other ethnic groups as well. Concerning education, there's a fascinating paper by some researchers at Stanford that suggests that a very important ingredient in better health and a longer life expectancy is accurate information about health behaviors. And the authors of this paper look at Swedish data where they're actually Sweden, for example, has single payer, so access to the formal healthcare system is fairly similar for people at different points in the distribution of income, but there still is a very strong socioeconomic gradient that the authors explain by differential access to information about good health behaviors by the poor and the rich. So education can be a critical mechanism for improving life expectancy.
So yeah, let's talk a little bit more about education from the student debt perspective, and like what does it matter how education is financed as to how much of a payoff there is?
Education matters a lot in the student debt market as well when you think of inequality. So if you complete college, it's very important to complete college, as well as majors actually matter as well. So college completion, even though you may take out a lot of debt, if you complete college, if students complete college, then the probability that the debt will be paid down is considerably higher. The chances of delinquency and default are considerably lower. Same goes for majors. If students are taking lucrative majors, chances are much more that the debt will be paid down and defaults and delinquencies will be much lower. So even in the credit market, there can be a convergence and reduction of inequalities because of education if there's completion, as well as STEM majors, business majors that students take and complete.
Just to echo that, so I think one important thing is even though we have all these problems with student debt, it's still important to note that the returns on average are there of getting a college degree. There's still very high returns. So lifetime income goes up by far more than the actual cost of going to college. But at the same time, there is a substantial group, as shown by high delinquency rates and low repayment rates. For some group, the returns are not there, ex post, after making that investment. So for many, it's negative. And a lot of it comes from people not completing degrees. A lot of it comes from people going to programs that are just don't have a good high return. And so we're looking further into what aspects of these programs really matter.
Okay, so we're almost out of time. Let me thank the panelists, and then I'm going to ask Raji to tell us a little bit more about what we have in mind for next steps. There's been some allusions to the future here, so maybe you could tease that out a little bit more.
Sure. So we have at least 2 blog series in the future that we have planned on different kinds of inequalities. In late winter, we are planning on a similar series which will focus on labor market inequalities and various dimensions of labor market inequalities. And there'll be 5 posts on that. And later in the spring, there will be another series which will focus on inequalities in the debt credit market. And there would be basically housing, both 2 posts on housing and some on student debt, defaults, etc. So stay tuned for this, and there's always work going on, and there are other venues, and we will also have panels like this, which would follow those series. And there are other venues as well that the New York Fed organizes that actually also kind of works on inequality or kind of alludes to research on inequality.
So let me just conclude by saying a big part of our strategy is you. So we're looking forward to your input both today and in the future. And so thank you very much for being here. And I want to thank the panelists again for a very enlightening discussion and very lively discussion. So thanks very much, and thanks to the audience.